Harish Krishnan is with us, co-CIO, head of equity at Aditya Birla Sun Life Asset Management Company. Harish, good morning. Good to have you here. Thank you for your time. I want to just understand what you guys are doing at Birla in terms of allocations, activity. And I want to preface that with something that you tweeted recently. You quoted data from a report from ICICI Securities, and you said that the number of companies in the top 500 where earnings yield is greater than bond yield is now about 47. The lowest reading was 32 in December of 2017. This is, top 500 universe where earnings yield is greater than bond yield. So just sort of prefacing my question with that data which you yourself put out. Go on, Harish.
Morning, Prashant. So what we have seen over the course of the last 18 months or so has been that risk has got disproportionately rewarded, especially as we go down the curve, be it in terms of mid, small, and more so in micro caps and, SME, lesser said the better. Now, in this context, what we are kind of doing in our portfolios is basically moving up the curve. We are trying to consolidate our holdings. We have increased our allocation to larger mid caps, trying to book our profits into many sectors which have done exceedingly well. We've also seen over the course of the last 6-7 months or year till date, actually quality as a style doing significantly better. And this was our call at the start of the year that, value had done exceedingly well over the course of the last 2-3 years. We did think that growth and quality would start making a comeback, and we've seen quality starting to make a comeback out there. Sectors like, say, pharma, where we have a large position, IT, again, a sector where we have an overweight, to a certain extent on the consumer or the consumption side. These have all been names that have kind of helped us, kind of position for this kind of a change, I would say, in terms of sectoral churn, which is happening. So by and large, the sense that we get is that one needs to be mindful of taking on more risk at this point of time. Doesn't mean that, we're going to see a massive crash, etc. But we do think that there can be a reasonable amount of churn in terms of performance going ahead. And that is what we are kind of moving and navigating within our portfolios.
So what's the kind of...
Sorry, Harish, hi, morning. So what's the top-down call now? First on the US economy and on the markets there, because investors are still grappling with the uncertainty of US health. Then there is uncertainty related to the elections. US markets are virtually at all-time highs, barring the little bit of a correction that we had last week. And historically, this has been a challenging year. So what's the call first in the global markets, US in particular, and then the flow through to India?
So from a US perspective, we do think that the corporate health of US is in very good shape. The consumer health of US is also in very good shape. So clearly, while there is an interest rate which has climbed up significantly and there is an anticipation of a slowdown and rates are likely to be headed lower, we think that this is possibly the most well-anticipated recession or slowdown in the making. Market observers and people and CXOs have been waiting and watching for this over the course of almost the last 18 months. So therefore, when it does happen, we don't think there's going to be a panic. Yes, in the near term, there could be some amount of consolidation, some amount of, steam which is going off. But we don't think that, this is a precursor of a massive fall or a massive correction in the US. And that kind of flows through across most other risk assets as well. Wherein we think that especially emerging markets, which have not really performed, barring India, could be a good place to be in, as and when the rate do get through over the course of the next 12-18 months. Coming through from an India point of view, I think, while we are going to see, continued strength in the economy, I think at the margin, and markets do work at the margin rather than in absolute terms, we do think that there is some amount of softness. So if you look at top line growth of corporate India, there has been reasonable amount of sluggishness. And while there has been a significant margin expansion, that helped through earnings over the course of the last 18 months, I think top line growth needs to be a lot more focused upon going ahead, given the fact that there is only so much margins that can go up. So in that context, we do think that it makes sense to be in fewer pockets where there can be a potential improvement in top line growth. There can also be fewer sectors where there can be a potential of significant margin expansion. So if I were to think about sectors where there is and which haven't performed well over the course of the last 3-4 years, sectors like, say, for example, cement, which has been a space which hasn't had a great 3-year run. We are seeing consolidation. Also, we do think that cement is a proxy play on energy prices because at every aspect of the value chain, it's essentially transporting energy, and lower energy prices therefore can help with improving margins. So I think that could be a space that we have a contrarian kind of a stance. Similarly, consumer durables is a space which hasn't done much over the course of the last 5 years. Of course, this calendar year it has kind of got its act right, but we think that there is still a lot more room to play out as far as consumer durables is concerned. So I think there are pockets where we do incrementally allocate, but a broad brush kind of a move is not something that we anticipate, especially in the near term, even as we continue to remain positive on the broader stance in equities from a medium to long term point of view.
All right, we'll ask you to hold on to your thoughts, Harish. We also have Vetri Subramaniam, man of many cycles, Chief Investment Officer, UTI Asset Management, joining us now. And as we speak, on cue, the market's extended its cuts. The Nifty is down by about 100 points, close to around 24,750. SBI is one of the stocks which is lower right now. The mid-cap index, when it started, was down 0.6%, now down about 1% as well, with a cut of almost 600 points. What are the stocks which are leading the declines? It's the same ones which led opened lower are now extending their cuts. So granules, for instance, now down about 4% as well. Good time to welcome you, Vetri. Where do you stand at where the market is right now? What are your thoughts, and what are the investment ideas?
Sure. Thanks, Manu. Well, not much has changed. It's still a reasonably richly valued market, and therefore one really has to, dig quite deep to be able to identify where there is value. I think what our messaging to investors has been that this is actually a time where one should be more concerned about risk. This is a time where one should be more concerned about asset allocation. Stick to the asset allocation in line with your, goals. This is not a time to dial up risk. If your neighbor is making more money than you are, so be it. You should be aligned with, where you think your asset allocation is tolerable relative to your medium-term outcomes. When you think about valuations in the current marketplace, I'd particularly point to the small and mid-cap space where, valuations are not only very rich in absolute terms. This is one of the few times in my career where small cap valuations have actually moved to a premium to large cap valuations, and that I think is very unusual, and also a sign of perhaps a need to be slightly more risk averse in that territory in particular.
Vetri, hi, morning. Sort of retail inflows are still gushing through this month as well as fast?
But we don't get daily data, but I don't think there's too much of a change, simply because keep in mind that essentially the pipeline that's coming through SIP is intact. But keep in mind, Prashant, and I think I've seen you all talk about this as well, there's a gush of supply coming through at the other side as well. So as a capital market participant, I'm happy that capital formation is well and truly underway, but I don't think this is a one-dimensional perspective that we should be keeping. There is a massive supply of flow which is coming through from promoters, from new issuances, as well as from strategic holders, including Ps and VCs. So every day you're flooded with a new set of either block offers happening in the marketplace, or QIPs, or OFS, or IPOs. So it's a very hectic market, and that's the reality of it.
I was talking to a banker over the weekend, and he said, well, everybody wants to do an IPO, and that is maybe not such an exaggeration as well. He was joking, well, it'd not be very far away when people securitize their own personal earnings and IPO themselves. I mean, just joking. But Vetri, but you know, the paper which is coming, again, very difficult to generalize. Is there a bit of euphoric element in how these issues are priced as well, or they are reasonably priced? A lot of what is coming, and you must be seeing most deals.
We do, but you know, we've been selective. We've been selective for a long time now, and I think it pays to be selective in these kind of environments. So you know, we typically don't participate unless we are clear that this is something we are willing to hold for the medium to long term. I think many people have seen the data about how much flipping is going on in the IPO market. That's certainly not something that we do from the fund perspective. So you know, we only participate if we are clear that we are willing to add to our positions at some point and stay invested for the long term. So you know. But I don't want to generalize, because I think you've just got to treat each IPO on its merits rather than generalize it.
Harish, have you all been participating in any of the IPOs?
Of course, we've been participating, but I guess we've been selective as well. So roughly about 1 in 5 IPOs over the course of the last 3 months is where we've generally kind of, put in our monies. I think, as Vetri said, it's great to have formation through the equity markets. We do think that many of these IPOs need to be evaluated so that, we are ready as and when we get greater comfort on valuations. And more importantly, like I said, it's more an assessment of the risk that we see at this point of time, wherein we want to consolidate into our holdings rather than adding to the tail. So that really is the focus at this point of time. Because, rather than having a fringe holding wherein we may get, say, 10, 15, 20 crores, we would rather want to consolidate at the top where we can take meaningful bites of, say, 1,000, 2,000, 3,000 crores. And there are many listed companies which have not kind of been in the limelight over the course of the last 3-5 years, which do provide greater margin of safety for us, wherein we are moving our overall portfolios towards.
All right. Vetri, you did, and both of you all actually, to be very honest, did stress a lot on asset allocation at current point in time. As we speak, in fact, the Nifty bank's taken cues and has recovered from the lows, moved mildly into the green. But on asset allocation itself, you said you'd be happy to underperform in the very near term so long as you have all your portfolio investments, etc., secured over the medium to long term. For a moderate risk capacity individual, what should the asset allocation be according to you, Vetri? And in the allocation towards equity, in that, what according to you would be your sectoral breakdown?
Sure. Honestly, that's a very difficult one to answer, because I think every person's risk appetite and financial goals are different. But what I can talk to is essentially the kind of asset allocation which we manage in the schemes where we take responsibility for asset allocation. So if you look at our multi-asset allocation fund, our net equity exposure can come down to a minimum of 20. It can go up to a maximum of 80%. Currently, we are less than at the halfway mark at about 45%. So in a way, it is an underweight equity stance in the context of asset allocation that we make in that scheme. And that's a function of valuation. So I wouldn't presume that this is the right number for everybody. But really the point that I would make, and I keep getting asked this question, when will the market correct? Will it correct over time? Will it correct in a sharp cut? And the answer to that is that we really don't know. But there is a way for every prudent investor to prepare himself or herself for those kind of outcomes by sticking to your asset allocation rather than trying to predict when the market will correct and how it will correct, neither of which I have seen anybody do consistently and accurately over 30 years now in the marketplace. So, use the tools available to you rather than focus on something which is impossible to do. In terms of sectors which are attractive, honestly, there's only one sector top down that we find reasonably attractive at this point of time. It's a combination of above average fundamentals with below average valuations, and that, roughly speaking, is the banking and financial services sector. So though that's the one sector where I have absolute comfort.
Again, only half joking. I've been Mangalam in asset allocation usually, but asset allocation, gold and equity and debt, etc. Right? Right now, asset allocation means
in equities,
large cap, SME, micro, mid caps.
And not to lose sight of a lot of people who are sitting on the sidelines, while the unlisted space as well.
I'll tell you, I was at an event a month, maybe it's been a month now. There was a fixed income CIO, there was an equity CIO. The fixed income CEO was more bullish on equities than I won't name names here, but that's the kind of market we're in. Vetri, the old saying, right? This time it's different. You sometimes do feel that, and that's the beauty of markets. They, the rise can make you believe, the fall can make you believe anything. And you start to you really have to pinch yourself to say, well, this has happened before. But what's your sense? I mean, I'm not saying, well, the question is not whether this time is different, but do you think there are things maybe a little different, maybe a little more supportive of the underlying sort of exuberance that we are seeing? And I'm sure you would agree with some, right? And disagree with others. Just briefly, if you can share your thoughts.
Yeah, sure, Prashant. Look, it always is the case that when valuations are rich, you've got news flow, which is extremely supportive. And when valuations are, at the cheaper end, the news flow is rarely supportive, right? So this is the reality that we deal with in the marketplace. Could things be different this time around? Maybe they could be. But, I've learned the hard way that rich valuations tend to sort of eat into forward returns, whereas cheap valuations tend to add to forward returns. So I'm not suggesting anybody go 100% into fixed income or whatever other asset class they deem to be attractive relative to rich equities. All I'm saying is stay the course. This is not the point of time where you want to look at what others are doing. Now, I hear things like this is India's decade, this is India's century. As an Indian, I'd be delighted to see that happen. But as an investor, the lesson that I've learned over time is that prudence and risk management is the only way to stay in this game for the long term. Being invested for the long term is as important as what happens. And what people forget is that if you overextend yourself, if you leverage, if you overextend yourself, you compromise your ability to stay invested for a very long time. And the most important part of the compounding equation is not how fast you go, it is the period of time that you are able to remain invested.
Great conversation. Thank you, Harish and Vetri, for your insights in the markets and the way ahead.